All right, let's get straight to it. We're here today to talk about eBay, and specifically, the significant gap between the story they're telling the public and what's actually happening under the hood. We believe this isn't just a difference in perspective, it's a divergence that likely constitutes a material misrepresentation to investors. So let's start with the official story, the one you'll find right in their annual report. eBay wants you to believe they're on the cutting edge, creating highly personalized and inspiring shopping experiences that are powered by advanced technologies. It's all about AI, magical innovations. This is the narrative they're selling hard to the market. And you know what? It's working. The market is absolutely buying it. Look at this, a nearly 23% surge in the stock price in a single day, all following a recent earnings report. That's the tangible power of their public messaging. But for us as analysts, a jump like that is a massive red flag. It forces us to ask the critical question. Is this surge fueled by real, sustainable growth in their core business? Or is it smoke and mirrors? Is it financial engineering that misleads the average investor? Okay, section 1. Let's start by poking at that shiny public image and see if we can find some cracks in the facade. While the C-suite talks about magical AI, the sellers, the people actually on the ground, tell a very different story. They've nicknamed the company's AI listing tool the INAD machine. INA, of course, means item not as described. So instead of helping, this vaunted AI is reportedly just making things up. It's injecting falsehoods into listings, which directly leads to more disputes and more costs for sellers. And the disconnect is just jarring. You'd think with all this talk about AI, their core dispute system would be, a little more advanced, but it's not. At its heart, there's a primitive, hard-coded 500-character limit. That's it. It's basically a tweet. How is a seller supposed to present a comprehensive case and submit evidence with a limit like that? It's a structural flaw that undermines any claim of a fair process. And this isn't just theoretical. It causes real financial harm. Take a look at this documented case of return fraud. A seller gets a graphics card returned, but it's been swapped for a different one that's impossibly pristine. The original showed clear signs of use, but this one, nothing. It's a physical impossibility. Yet eBay's rigid, automated system was completely incapable of addressing the obvious fraud. The seller was forced to absorb the entire loss. Section 2, accounting sleight of hand. So if the profits aren't coming from operational excellence, where are they coming from? Well, a quick look at the financials shows how some clever accounting choices are helping to juice the bottom line. First up, we've got a classic move from the earnings management playbook. In 2024, eBay just decided to extend the useful life of its servers from 3 years to 4. It's a simple change, disclosed in the fine print of the 10K, but it has an immediate effect. It lowers their annual depreciation expense, which in turn inflates their reported profit. And the bottom line impact of this one change? An artificial boost of 12 cents to their full-year earnings per share. This is profit that wasn't generated by selling a single extra thing. It was generated by a discretionary change in an accounting assumption. The second and much bigger source of non-operational income is the financial float. We all know what this is. eBay holds onto billions of dollars of its users' money before paying it out. And in a high interest rate environment, the income they earn on that float becomes a really significant source of profit. It's basically a massive interest-free loan from their own users. Let's actually quantify that. This table shows what happens when we adjust eBay's income by backing out that interest from the float, all $289 million of it. You see their pre-tax margin compressed by 270 basis points. It falls from nearly 27% to just over 24%. This shows a major dependency on a low-quality, non-core revenue stream that isn't exactly front and center in their investor presentations. On to Section 3, the hidden liability. Because this practice of earning interest on customer funds doesn't just raise questions about earnings quality, it also creates a huge undisclosed legal risk, especially in Canada. And it all comes down to this one simple question. Is eBay a marketplace or is it a trustee? Now, their user agreements will tell you they have no fiduciary relationship. But we'd argue that their actions under Canadian law have already made that disclaimer totally void. Here's why. Under Canada's Excise Tax Act, when a marketplace like eBay collects sales tax for its sellers, It is legally designated a deemed supplier. This isn't optional. It's a status that automatically makes eBay a trustee for those funds. And this is the legal linchpin right here. It's a statutory obligation. You can't just write a line in your user agreement to get out of it. By collecting and remitting taxes, eBay has, by its own actions, accepted the role of a trustee. The legal doctrine of estoppel prevents them from arguing otherwise. They can't act as a trustee for the government and then turn around and deny that status just so they can profit from the float. This creates a massive undisclosed liability. So let's move to our final section. Section 4, the case for investigation. When we put all this evidence together, the pattern we see strongly warrants a formal inquiry. So, to summarize the case for you, we have a public narrative of high-tech innovation that's directly contradicted by the actual user experience. We have reported earnings being materially inflated by non-operational engineered sources. We have systemic risk being pushed onto users, and we have a significant undisclosed legal and fiduciary liability in a key market. And the last piece of the puzzle is the timing of stock sales by senior executives. The CEO, Jamie Iano, for example, put a plan in place to sell 90,000 shares right before the period of peak AI-related hype. When you see insider sales lining up this perfectly with a narrative that seems unsupported by reality, well, it raises very serious questions about intent. And this leaves the commission with the final question. Is the market rewarding genuine innovation and fundamental business improvement here? Or is it reacting to a carefully built story propped up by accounting tricks and undisclosed risks that lets insiders sell their shares at inflated prices before an inevitable correction? We believe the evidence points strongly to the latter, and it warrants your immediate attention.